Today we're doing a roundtable with the Rock Harbor team talking about observations we're seeing in the marketplace and sharing some interesting thoughts as we go around the horn here. I'm joined today with Sean Richland, Mackie Daniel, and Scott Lindsay. Let's kick it off. How's everyone doing today?
Hanging in there, man. Great week. Beautiful week here in Michigan. The weather's been unbelievable. A little unseasonably warm, and we're getting a chance to get some rounds of golf in, which is always great. And I always love this time of year, though, when the leaf changes come upon us, and college football's here, and lots going on in the world of sports that we'll go through as well.
Definitely. Mackie, how are you today?
I'm good. Somebody made a really, really good pot of coffee here in the office this morning. Feel free to take credit, whoever that may be. We know it wasn't me. Now NHL starts up this week. Fall golf, wedding season continues for the millennial generation, and it's hard to believe fourth quarter's already here. So it's great.
For the record, I made the coffee. It's the you got to hit the strong button. That's what does
Proud
it.
of you.
Hey, for millennials, can anybody have a normal wedding anymore? Like all these crazy weddings that are going on, people traveling all over the world for a wedding. What happened to like putting a tent in a field and just getting people together? Is that still going on, Mackie, in your wedding situations?
Sometimes. I think back to ours a couple of years ago, we very much did inquire about tent in a field, and it ended up being a more expensive quote than the option that we went with. Shout out to Blue Bridge Event Center in Grand, Michigan.
Oh, free shout out.
Yeah, free shout out. It's we looked at a plot of land, and it was more just to get the tent to the place than it was to have a full capabilities facility. So it's crazy. It's crazy. I wish kind of like '08, what were you doing in '08 where you weren't buying houses? Because I was in high school. I wish I'd bought a wedding venue when COVID hit, because holy cow, the demand is here for it right now. It feels like we're still backlogged on that.
I actually just talked to a family about that. They owned a golf course up here north of us in Rochester, and they're putting in a massive wedding event center. So seems to be a good business, Mac. You might be onto something.
I think the destination weddings are a larger commentary on society at large. It's a good way to trim down the guest list. Maybe the awkward, distant family members you don't want there.
Gosh,
gives them an easy out.
We thought that too, and unfortunately, it didn't work out for us. We did a Florida destination wedding, which everyone showed up, but it's a story for another day.
Yeah, and you're talking about kids now. You did that how many years ago?
It was a long time ago, but we did it for your reasoning,
and it didn't work out.
Interesting stat about your weddings, though. Even though they're a little bit more quirky, people are waiting to get married until older. And what do you think the direct result of that has been?
Lower birth rate?
Lower divorce rate.
Oh, there you go. Wow, Scott. We learned something today.
How about that for a useless tidbit of knowledge today?
Are we down to 50% from 60%, or?
I don't know. I didn't get the stats. It's on the internet, so it's all true.
Right, and 80% of statistics are made up. So
there you go.
Take that with a grain of salt. All right, I think we jump into it. I want to kick it off just talking about AI broadly. So bubble or durable growth, and maybe look at some of the parallels to the .com era. I think it's interesting because I think we're in an environment where somebody mentions AI in their reporting and their stock price goes up.
Well, I think the terminology bubbles, it's not a bubble. There's no bubble. This is here to stay. It's going to be used throughout society no matter what. I think the bubble, maybe, Jay, you're talking about would be, are companies just throwing the word out there? Are they people just building industry-type companies that are going to block on it? There are too many of them being built. But I think the concept of AI is here. It's going to be used for a long time, and we're utilizing it in our business. I think, Scott and Mackie, you can speak to your conversations, but every conversation I'm having is coming up. So the bubble may be the fact that there's too many companies coming in, but there's no bubble in the knowledge that's going to be used inside of companies. It is going to be used. It's just a matter of how much it's going to be used.
Well, and I'd say that harkens back to the .com era too. Like obviously that was a transformational time.
Yep.
but it was, I mean, just adding .com to your name was going to increase the stock price,
Right.
increase your value.
Sure. Everything.
Well,
out there.
you think about it, JJ, it's not an either or situation, right? You brought up the .com. It's both. The question is which one's going to be more impactful, right? We had a pullback in the .com, but it accelerated growth in this country post, .com era. Are we in that same phase where there's going to be, first guy through the wall gets bloody? But I don't see this as an either or. I mean, we can still have a bubble and have durable growth, but we're going to have to go through a transition period, possibly. Like Sean says, a lot of people coming into the market, everybody's throwing at it. We see what happens with the Mag 7, but that doesn't take away the long-term impact.
Scott, do you think the long-term impact is positive for growth?
Again, change is always going to raise questions for people, right? You go back, I mean, we're here in Michigan. You go back when Henry Ford brought on the assembly line, and that was going to take people's jobs away, right? This is just another cycle of technology and things coming into the marketplace. I think somewhere in this, JJ put a stat down that 20% of the jobs that people have today did not exist in 2000. Well, what's that stat going to look like, right? This is going to create new jobs. It's going to remove old jobs out of the workforce. But those workers need some place to go. I mean, ultimately, this is where new industries will pop up, side industries. People will figure out how to support, whatever is going on in AI and technology.
Well, and I think there's going to be phases to it, right? So I was trying to coin the candy cane jobs curve of AI, which essentially is the inverse J curve, where you have this increase in the picks and shovels aspect, the infrastructure aspect of AI. And then when the efficiencies permeate the entire ecosystem, you're going to have this precipitous decline in jobs. But to your point and to that stats point, there's going to be new jobs created out of it. So I think we'll evolve.
Didn't one company just come out and say that every job will be affected? It might have been Walmart. They came out and said every single job will be affected by AI. It's just to the extent of which it is and how it plays out over the time of how it's integrated into the system. Like in our business in financial services and for financial advisors, it's going to be, I think it's going to be a really efficient tool to ultimately build better portfolios, more efficient training, better compliance, up and down the list from a standpoint of how it can help the business overall. What becomes interesting is the types of apps that are out there now where people can trade. I think that's where it's going to be pretty fun to see how this develops over time.
Well, and does information become commoditized? Everyone has it at their fingertips.
Well, and that's the concern for advisors, right? I mean, the folks who are going to excel in this environment going forward will figure out the best way to blend the art and the science, right? If everyone leans into AI, to your point, Jay, it becomes a commoditized industry because everyone's going to be feeding off the same information and intel.
We've heard that for years, though. I mean, if you think about that with like robo advisors, that was the big thing that was going to take off. To me, it's all relationships still. Like the advisors have to be more active with their clients, get in front of them. If you have someone who lives, 15 miles away, don't do a Zoom meeting. Go see them. Go talk to them. Go get in front of people. And this is a relationship business. You got to be able to have trust. There's things that happen in life where you need someone there to help you through it, whether it's you retire and you got to start taking distributions, you have a trust. There's all sorts of things that the relationship matters. And I think now more than ever, you have to make sure you get in front of the client.
Well, and the advisor's job is so much more than portfolio performance.
Oh,
there's
just a piece
a million aspects to it. If you're selling yourself on performance, you're going to live and die on performance. There's going to be a time when you're wrong and you're going to lose all your clients because you're just selling on that one number. So the relationship, to your point, is extremely important.
I think one of the most interesting things that's going to come from this is, the commodity inputs that go into it. And the natural resources that are required for the build out. I was reading an article from the Journal this past weekend. A lot of these smaller companies are taking on a ton of debt to come out with the technology that I personally think is essentially going to be integrated into the big players that aren't going to need to debt finance to acquire these cash-rich companies like Oracle, NVIDIA, SoftBank. But what are the opportunities for investment in land that the AI build-out's going to need? Is it going to be renewable resource fueled for the amount of energy that it's going to take? And if I'm an advisor and working with a certain set of clients that have the capital and the ability to get out in front of the inputs or the land required for that, it may be an interesting way to pivot some of their alternative exposure, maybe on a deal by deal basis. But I think the build out that's going to be required for this to be fully integrated across all companies in a really efficient way, it's going to be fun to see how that plays out over the next, call it 5 to 10 years.
I would agree. And when most people think about AI, they're thinking about large language models like ChatGPT. There's so many other applications. I mean, you look at robotics, you look at just generalized automation, you look at vision models. I mean, there's a lot more to it, and the general public just thinks about the large language models.
It's a good point. And you look at so many industries being affected. The automated industries that are out there are not the only ones that are going to be affected. Farmers are going to be able to utilize AI to help them harvest crops more efficiently and develop things more efficiently from their standpoint. The list goes on and on. But the exciting thing in our world is, how do you balance this exposure, and what do you do from an investable universe to make sure you have exposure to the companies that are using it, but you don't overexpose to the fringes as far as I see. There's no point in trying to hit a home run in this. I think you look at the companies that are going to utilize it, that have large scale, they're going to benefit the best, just like we saw in the .com area, just like we saw in the internet area.
Yeah. This is going to be a period of George Brett and Tony Gwynn type baseball. Singles and doubles, line drive, make contact, get it in play.
I'm going to have to sweep Wade Boggs in there with you.
I mean, I thought you were going to say guys who had huge dips in when they played baseball. George Brett and Tony Gwynn.
Make baseball great again. That leads us into an interesting thought process when we think about valuations today in the equity market, narrow leadership, sheer concentration. I mean, one stat I've been thinking about, and it has to do with advancements made by a lot of these companies on the cutting edge of artificial intelligence and large language models, is just looking at the narrow leadership in the S&P 500 and the crowding. If we took a pre-GICS reclassification of 2018, the tech weighting in the S&P 500 would be around 40%.
So meaning the companies that were stripped out of tech and went into
consumer communications and exactly.
So it'd be 40%. So now you've got a significant overweighting just to tech, but those companies are growing. I mean, they're the ones it's the growth model of the world.
Well, and that's an interesting stat when we look at the first $1 trillion company was Apple in 2018. Mm-hmm. So we're talking 7 years. Now Apple's at $3 trillion. There's been 3 other companies that have crossed that $3 trillion threshold. I think they're down a little bit now, but that's a 3x growth rate. Earlier, Sean and I were talking, if we went back to 2011 and looked at Apple's market cap, it was about $320 million. So is this going to be just a consistent 3x every 7 years?
I mean, I just got the 17 Pro. I mean, I don't know how many versions of this thing I've had, and I've used an iPhone. I've never used an Android, and I don't think I would ever use a different phone system. And I have AirPods. I mean, it just keeps going and going and going. They're going to find ways to get in and grow that market cap, is my belief.
Well, it's basically a subscription service at this point. You're just re-upping every time it's available with the new technology, the new cameras.
Well, and they're smart, too, with how they do it, right? Because if you have Apple Music, which most of us have, they raise it $1 or $2. No one cares, and they just do it every year, and all of a sudden, that's a huge number to the bottom line with the number of users they have, and they keep increasing that, and then they come out with a different tool or a widget. But
when you add in all the streaming services, and Apple's doesn't have as broad a base, but they have the highest quality content that they're putting out. So everybody's looking at different ways. Jason, you talked about it with valuations, right? And it kind of reminds me of the scenario that we've come up with a couple conversations where advisors know that they're overloaded, they know that they're overexposed, and then the roadblock is the conversation with the client. We've had conversations about making some changes, and they said, look, we can't even get people to trim their Mag 7 positions right now, right? So clients love winners. They see them doing well. And I think that's probably a precipice that advisors are teetering on right now is we know we need to pull back, but my clients are pushing back that they don't want to do it. I mean, I don't know, Mackie, Sean, if you guys come across any of that, but that was a rather large team, a rather sophisticated team. And their first problem was getting people to trim their Mag 7 positions.
Yeah, but they've been right. I mean, at the end of the day, it's been the right play, and it's worked. And that's what the problem is. It's not a problem. I think it's great. It's great for our country that these continue to innovate. And I'm a big believer in American capitalism, and I think it's going to continue to stay, and it's going to continue to grow. It's just a matter of how does AI infiltrate these companies? Who's going to have the biggest growth curves are the folks that use AI to the most efficiency and grow their businesses, and those are the companies that are going to win.
Absolutely, and it kind of permeates across all industries. It's not just tech specific.
Right.
Which I think will be important. So the question to argue is, do we think we're late cycle?
From what standpoint? The overall economy or from?
The overall economy. I mean, we've been in this huge upswing. Could we argue for a late cycle environment where you want to shift some of your portfolio exposures to the factors specifically that outperform then? So I would think quality, minimum volatility, even value is going to be historically underweight.
I think you always got to have exposure to that, right? I mean, you don't want to stay away from that stuff. It's great ballast for the portfolio. If we're late cycle in growth, then I think the international is an interesting place right now. Everyone's underweight it. I mean, if you look at the average portfolio, I think there's less than 5% exposure to international right now. And I don't know, Mackie, you might want to correct me on these numbers, but I think the EFI's up. Is it 22 this year or something?
It's doing well.
It's doing well. It's had a good run, but at the end of the day, are we late cycle or not? If you buy good companies, it shouldn't matter.
Yeah.
One thing I think is interesting when we think about mean reversion, and I think late cycle tends to historically come with some mean reversion. Over the last 35 years, and this was a piece Eaton Vance put out that I took a peek at recently. So 1990 through 2024, there's only been 3 calendar years where 30% or less of the constituents in the S&P 500 outperformed the broad index. 1998, 1999, it was like 31, 32%, so concentrated there, in 2023 and 2024. Other than that, everything's been north of 30% of the constituents outperforming. Look at a year like 2022, we know S&P got crushed. Just under 60% of the names outperformed the broad index. When we get levels of concentration like that, at least coming out of 98, 99, there was a big spike in other names outperforming the broad index. And this piece argued for quality, low vol names. So, don't run away from the cow that's brought you all of this milk, that being the Mag 7 and the tech names. But this is where the job of psychologist for an advisor, I think, becomes ever more important. Do you siphon off a small percentage of a growth allocation that you start to draw income from? If it's a late phase accumulator, soon to be retiree, that's going to need to take some income. So if you're taking income, your growth rate is going to outpace the amount of income you're taking, so you can still gather. But just looking at that data, at some point, we can't have this concentrated of market leadership. I would think. Could be totally wrong.
Right. Well, part of it is, from our calls we've done with Rubini lately, he's like, my base case is X. Your base case may be Y, but what happens if X becomes the reality? You have to be prepared, and that's just a diversified portfolio.
Diversification still matters.
Yeah, no doubt.
Well, the problem with the cycles, right? And this is something that Richard Bernstein had said probably 8 or 9 years ago, is the cycles are still the cycles, but they've become elongated, right? So with this cycle, are we seeing the same type of head fakes, right? So I think back to 2010 and 11, and Jay, you were at BlackRock, I was working with Allianz and PIMCO, and I felt like every quarter we were telling everybody, no, rates are going up in May of 2012. No, rates are going to go up in, the end of the year. No, we're not going to put them up until 13, right? We have these head fakes. Are we in a similar environment? Because I feel like, all right, no, Mag 7's over. And then who rushes off the bottom? and we continue to see the leadership leading the charge. And, will we have any more of these fits and starts before we actually get to the tail end of the cycle?
No, I would tend to agree. I mean, one of my other, favorite lines from those days was, oh, the U.S. has outperformed international for the last 6 years. It's never done it 7 years in a row. And then it did, and then it did 8, and then it did 9.
Yeah.
So you got to be careful with those absolutes. One thing that I think Mackey's comments lead into is another buzzword-heavy topic in advisor land, and that is alternatives.
Well, there certainly has been a trend in that space. There's no doubt about it, and there's a lot of ways to look at it on the equity side and the debt side. And depending on what you like as an investor, do you like the higher opportunity to make capital, the 17 to 22%, or do you like the consistent income stream on the debt side in good industries and good spaces? We obviously know that banks are getting out of a lot of the lending between $20 to $100 million, and that's a great space to invest in, whether corporate or asset backed, depending on what you like. And one of the things in the alt space that is becoming, I think, more advantageous for the advisor to utilize is the entry fees coming down. So you've got ability to have more people get exposure to it. And you also have the sense that from where I sit that it's a good diversification model to put people into something that they're going to stay in it. It's not going to be quick liquidity. So over time, we saw the Trump administration come out and say, well, we want to move earnings from quarterly to semi-annually so companies can plan longer as opposed to having more transparency, less transparency. And you can fall on either side of that. But as a business running a company, the less transparency, you can make decisions that are longer as opposed to shorter. And hopefully over a long period of time, that would be more advantageous for the outcome of the business. Now, as an investor, if you don't look at it every 5 seconds, some of the best portfolios in the world are ones you just close your eyes and open them up in 10 years, and then boom, you've got great returns. So I do like that in the alt side where you can't just grab your money out of it right away. It's something that you got to stick to and over time get an income stream or a return.
Well, and one of the things I've seen a lot of companies advocating for is an alternative to the 60-40 model. So they're looking at a 60-20-20 perhaps. Mm-hmm. The question being, they were talking about alternatives in 401ks and mass affluent money now flowing into the alternative space. Does that hurt performance?
Just because it's overcrowded?
Correct.
I would say typically overcrowding would hurt performance. However, there's a big player that's gotten out of the space, right? And that's the banks. The regional banks have just gotten out.
So that's on the lending side.
On the lending side,
right.
For sure. Well, it could also be on the equity side too. At times, from because a lot of the banks were lending to the private equity companies that were pushing the money out on the equity side. So now you have to think about where's that capital coming from. But from the debt side, yeah, I mean it's huge. I mean, if the high yield market is gone because banks were the ones lending to it, and now you've got private credit out there that is lending, that market could be trillions of dollars. It could have a lot of room to grow.
Yeah, that's a fair point.
I think one thing.
Go ahead,
Scott.
No, go ahead.
I think one thing that's worthwhile to take a look at, and I don't have any of this data in front of me, it's more piquing my curiosity than anything, is the opportunity with there's so many more privately owned small businesses here, and I would assume around the globe. And if you were to look at the demographic of those business owners, and we've seen a lot of advisors focus on the exit planning recently. Are smaller players going to come in and want to aggregate? Around here, is there tier 2, tier 3 auto suppliers in their 50s and 60s? They don't want to do this forever. Is there going to be smaller alternative players that are gatherers of these that anybody can get into? Is there a demographic factor of the actual private business owners that's going to create more opportunity that helps steer away from some of that overcrowding? I have no idea, but it's worth looking into. Might have just created a project for myself. Who knows?
There you go. Because you need another one.
Yeah. All this free time.
Mackie, if they figure out how to make money on the transaction, they'll do it, right? So you think about what they've been buying into. Car washes, right, has been a hot dot. dental offices and dental practices. We've seen urgent care facilities being grouped together. I think any company demographic has that possibility of coming through to that.
Well, it's scaling efficiencies, right, Scott? So if you can take smaller businesses that are mom and pops and scale efficiencies, then you can ultimately create a higher valuation. 100%. That's what they're doing, whether it's urgent cares, mom and pops, HVAC companies, you name it, car washes. We recently had a guest on who talked about his car wash and how he went to the first one and it was guys in flannels and jeans, and the second one was
guys in suits, and ties.
So that's certainly something that's going on out there. But I think it's a great space to put capital into if you can over time. And markets aren't going to go up every year consistently, even though they have seemingly done that for a while now. You've got to figure out ways to diversify into things that, in my belief, are a little more closed, and you set it and forget it, and then you wake up and hopefully it does very well.
So one thing, as we kind of put a cap on that conversation item, one thing I think is interesting is if we look at the ETF versus mutual fund landscape, and particularly with exemptive relief applied for by DFA, I think they've already approved it, where you can have, similar to how Vanguard was structured, they had the patent on the ETF share class of their mutual funds. That patent expired in 2023. What does that mean for the ETF world and the mutual fund world? I think there's some benefits to both.
Well, let's take a look at flows, right? I mean, I don't know. We discussed the numbers this morning. The ETF flows in 2025 are astronomical.
We're on pace for a back-to-back record. So 2024 was a record at about 1.1 trillion in net ETF flows. 2025, we're already over 900 million.
Okay.
So there's some interesting
900
stats.
billion.
900 billion. That's what I meant.
Yeah.
And so the total ETF market is 12.19 trillion as of July.
Right.
I think we'll see that continue to grow. An interesting stat, though, is the advent of active ETFs versus just index beta-based ETFs. So June of this year, active ETFs, the number of active ETFs, not the assets, surpassed passive ETFs. So that was June.
Kind of makes sense, though, because passive is kind of roadblocked by the big carriers.
Correct. And fee compression when you're charging, 2 basis points on an ETF. 10% of the assets are inactive versus passive. So 10% inactive, 90%.
So
passive.
sitting in cash?
No, 10% in active ETFs.
Oh,
so
okay.
Actual people making decisions to potentially help a customer.
But here's where the numbers get interesting. For 2025 flow data,
okay,
35% of net flows have gone to active ETFs.
So does that mean there's just, in the beta world, it's just kind of going in and out, in and out, in and out?
No, I think there's more interesting strategies coming out.
I would agree with that.
As people are getting more creative. But it'll be interesting with this, if it goes widespread, that you can now issue an ETF share class of your mutual fund.
Okay.
The importance there is legacy mutual funds that have maybe deep embedded 401k assets can now maintain their track record and launch the ETF share class. Then the importance for that in non-taxable accounts or in taxable accounts is then capital gains could be eroded through the ETF mechanism.
That would be super helpful for the mutual fund companies.
Completely agree. So there's a benefit there. On the other side of that coin, a lot of asset managers who jumped into the ETF game can now do the same thing with a mutual fund. So if they haven't historically played in the 401k universe, they can now have a mutual fund share class of their ETF.
So essentially it's a backdoor into the 401k land, which is the largest growing. Defined contribution is great business. I mean, if you can find a way to get a fund in there and grab assets, it's coming every month, right?
Correct.
That's the last bastion of mutual funds,
Yeah.
right? That's the only place that they're really left. ETFs don't have access to it. Most 401k platforms won't allow.
But now, Scott, he's
fractional
saying they
shares.
will. He's saying they will have access to it. So it'd be huge.
Well, but a lot of can't get me wrong, people who have the mutual funds and big already in 401k and they want to get the ETF share class to get it out, not the other way around.
Right, but
Or
there
are you
isn't.
saying that with an ETF share class, they'll be able to put their mutual funds into 401ks because it's a mutual, like that's what I got to dig under the hood on.
No, so ETF managers will be able to have a mutual fund without
With-
launching a separate
So it'll
fund.
go both ways.
So they'll be able to.
Yeah.
It'll go both ways. They'll be able to maintain their track record and have a mutual fund ticker, and end of day settlement.
And maintain track record, which is key because you got to have the, all the different versions of tracking that people want to have before you can get into a plan. And if you have a new track record, you can't get into a plan.
The thing that will be interesting on the taxes is when it was index and passive, it was pretty straightforward, right? ETFs traditionally do not spit out capital gains, but they absolutely can, right? But because of the way they were structured, they were indexes. You would have had to run on an index for them to have a liquidity issue, right? So now with more active, are we bringing more potential taxation scenarios into the portfolios, right? Because even though you can ACAT stocks, a lot of these long short strategies, they're using options inside. Like, I'm just curious as what that impact could be longer terms. They'll still be tax efficient, but will there be tax implications to some of these changes and the increase in active?
I would say there has to be, depending on how often it's being traded. So the more active the strategy, there's even being able to ACAT, if you're trading every day, there's likely going to be a tax implication in there.
There's very few active managers that are trading every
Correct.
day, though. I mean, that's pretty much gone by the wayside, I think, unless you're in a crazy active fund. And most guys are making, 10 changes, 15 changes a year, maybe. I mean, there could be more than that, like you said, Scott, in long, short, or whatever, but for the most part, they're not. At least the ones we deal with. I'm sure there's some out there.
Right. There's probably some
that do that. Getting back to your point on the ETF and passive versus active, because something like IBIT that comes out garners a crazy number of flows, and
fastest growing ETF ever.
Yeah, and so the Bitcoin thing is real. I think everyone can agree on that now. It's here and it's not going away, and the returns have been phenomenal. It's got unbelievable leg room to grow in different industries. You're seeing amazing IPOs in the space. You're seeing growth that we haven't seen. So I think anything that comes out, you're never going to see that in a fund ever again. It's all going to be in an ETF. So anything that's innovative that's coming out that's going to be utilized is going to come in an ETF. So to me, these fund companies have to find a way to work that line over to the ETF space.
And I think net flows, I can't remember what the date was as of, net flows was $25 billion year to date.
A brand new strategy.
And IBIT.
Yeah. So they solved a problem, though. They did. They solved a problem. People who wanted access to Bitcoin couldn't get it. And this is a way to essentially syndicate that access.
From a revenue to the firm standpoint, the expense ratio is 25 basis points, I believe.
Yeah.
So it may be generating more revenue than their S&P 500.
Yeah.
Some of their bigger.
Which are at 2, 3, 4 basis points.
3 basis points.
Yeah.
Somewhere around there.
So it's a big deal. I'm curious to see how this all plays out, though, Jason, to your point on how if the ETF companies will utilize this option to get into 401k plans, and if mutual fund companies will utilize this option, and how it's all going to play out, because there is a lot of gray area on the best option and how to do this.
I agree.
I think it's.
Go ahead.
I think what's funny is you had JP Morgan come out and you had DFA come out, and these were big events, and JP Morgan had a whole bunch of funds. Dimensional Fund Advisors does their entire lineup and converts them. The stats that I've seen look like these conversions to ETF have had a massive impact to their scalability and flows. The question then becomes is, why haven't we seen anybody else on that scale stepping in, right? There's got to be people out there looking at the fringes, but the numbers are too compelling for some other big players not to jump in and try to convert their mutual funds.
No, I think they will not necessarily convert, maybe maintain the mutual fund and have the ETF share class.
Yeah, just do a pari passu with the same product, right? Yeah.
Right, because then you're maintaining. I mean, you have seen big managers convert lesser funds into an ETF, where it goes fully wholesale from mutual fund to ETF. But now with the share class, is there even a need for that?
Yeah, probably not.
You can maintain your mutual fund and have the ETF share class.
I'm going to put on my my pessimism hat that we all are acutely aware that I never ever put on.
Here we go.
At what point do you think we see this growth of active ETFs continue to surge, but the closet indexer that we saw in mutual funds, especially call it the last 10 years, become an issue where, oh, we've got an active ETF, and then you look at it and there's really not a lot of difference between what's out there for 2 or 3, 4 basis points in just buying an index product.
Well, that's why active share becomes such an important piece of the overall risk metric for the advisor to look at, right? I mean, if you're going to pay for active management, you should have a decent active share. If you look at McAteer, to Jason's point on the mega cap concentration, I mean, 4 companies have crossed $3 trillion: Apple, Microsoft, NVIDIA, and Alphabet. If you don't own those 4 companies to at least market cap weight, you're gonna be trailing the S&P. And if you want active share, you've got to find ways to do it, and then you'd have to probably be underweight those 4.
Right, and thus underperform.
Right now.
At least lately.
Yeah. Mm-hmm. So it's a good question, Mackie. I don't know the answer to it, but I like your question.
When we get active alternative ETFs, that'll be the way to bolster it.
There you go.
Ding, ding,
They're
ding,
here. They're just called active.
Get out the tinfoil hat.
They haven't figured out there's another alternative share, another class, right? We just throw everything in the alternative bucket.
I'm more of a parchment paper hat guy to see if for alternative they're cooking on the metal. Alts.
Oh, that's good.
God, remember when alts just were like a long short strategy? That was considered alt, right? Now when you talk alt, you literally have to ask people, what does alts mean to you? Because everybody looks at it from a different angle and everybody lumps everything into that bucket.
Well, that is a catch-all, much like AI is a catch-all now for any innovation. The one thing I've seen research reports that have come out on what's quote unquote alternative, and it ends up being just a super high amount of equity beta that they can charge 2% for. So to find those true differentiated drivers of return, which is important from a diversification standpoint, is a little more challenging than just taking someone's word for it.
Well, the problem when you put privates in that bucket, right? There's a lot of instances where people have had very bad experiences in an alternative strategy, right? Because when they have that exposure on the upside, it's great. But when it flips on them, that exposure is magnified to the downside, right? That's not necessarily the case when we look at privates. But when you think about retail clients or high net worth clients, I don't know that they're necessarily making the differentiation. They might have owned a fund that pounded them 5 years ago, and they think private credit, equity, or debt might be doing the same thing.
Yeah, all things to think about. I think we've made advisors' jobs more difficult with our conversation today. Just more hats to wear and more thoughts going through their heads.
Yeah, absolutely believe that the biggest thing right now, from what I see, is the team makes the most difference for advisors. When you have a great team and you're able to stay in front of your clients and do a great job for them and keep them happy and ultimately knowledgeable on what's going on, that's what's winning out there right now. And I don't think that changes from year to year, from product to product, or any of the nuances that are going on in the marketplace. It's the teams that show up, continually do a good job of educating, planning, keeping their clients on course that are winning. And that's going to continue to be the case on a go-forward basis. But that's kind of what I'm seeing out there, at least in my travels. Speaking of travels, I got to tell you guys about my trip last week. I was out in San Francisco, got to go to a Giants game. There was, I think, 25 hits in the game. Okay, 25.
Wow.
I don't think the Tigers have had 25 hits in the last month, although they did win last night.
They had 5 hits.
They had enough yesterday.
5 hits yesterday.
But I was out in San Francisco, beautiful city. But I did find it kind of interesting as you're walking around. They have Padel out, the Rackets game, which I'm sure our resident Rackets player Jason Johns is familiar with. If you haven't played Padel, it's a pretty cool sport. But But as I was walking through, I was expecting to see all sorts of, people messed up on the streets, and it really wasn't at all. It was nice. It was clean. Except I did see one lady totally out, and people just walk by like nothing's going on. It's fine. Just walk on by. No ambulances, no nothing.
So is that confirmation from our conversation with Andrew Fentress about what's going on in San Francisco and the revitalization and how the city's on the up?
My on-ground report. It was an on-ground report. Yeah, it was nice. It was a beautiful day. People are out having fun, and no real issues I felt at all. But I had a great time at the stadium. If you get a chance to go to Giants Stadium, it's one. I went on StubHub at 3:00. Game was at 7. $40 a seat, lower bowl. Oh, that was pretty good.
Fantastic.
Pretty good deal.
Heard that is just an incredible environment. I still have flashbacks to 01 when Barry Bonds broke the record. All I wanted to do, I think I was 8 years old, was rent a kayak. I probably wouldn't even be able to see over the kayak.
Go out in McCovey Cove.
And go out in the cove.
Yeah.
Just go wait for a ball in the cove.
Mackie and I had a conversation yesterday. Do you know who his favorite baseball player was?
His? I'm going to say Derek Jeter.
Before Jeter.
Before Jeter?
Cecil Fielder.
Oh, yeah. He was a good one. He was a legend around here.
Who was also a Butte Copper King.
Oh, there you go.
Which was a team in Butte, Montana, once owned by Bill Murray.
Like the comedian Bill Murray?
Correct.
Really?
Yeah.
That's interesting. Bill Murray he's going to be playing the Dunhill Lynx this week coming up, which I don't know if you know what that is, but that is the event over in Scotland where they do one pro and one celebrity or something in a group. They play at Kings Barnes, I think Carnoustie, and the Old Course. He always chucks people in the bunkers at Pebble Beach, old people. Like I always feel like someone's going to break a hip.
Yeah, I've
Have you seen
his shenanigans in the past.
Yeah, it's like, dude, you can't chuck an 80-year-old lady in a bunker. She's gonna.
He might be 80.
He might be. You're right.
Yeah, that's not that old anymore.
There's a story about him. He walked up to somebody at like a food court at the mall. Walks up, takes a fry off their tray, eats it, and just says, "No one's gonna believe you," and walked away.
Which is amazing. I mean,
awesome.
It's such a legendary move.
That's so good.
All right. Well, I think, since we brought up golf, let's really quickly just address the Ryder Cup and the absolute debacle that was.
What part of it do you want to address, Jason? Do you want to address the part where the USA lost, the whining from Europe on the fans? Like, what part are we addressing?
Well, the fans were ridiculous. I think we all can. They were all Yankees fans. Let's be honest.
Look, if you strip out the outcome, and anybody who's a golf fan who watched the Ryder Cup can't tell me that was the most amazing display of golf you might have ever seen. Now, we did not get the outcome we want, but I mean, how does Bryson DeChambeau and Scotty Scheffler shoot 9 under through 16 and lose 3 and 2?
I'll tell you.
I mean, unbelievable golf.
That's true on day 3.
That was day two.
That was day 2.
In the team match, they got worked by just a team that played out of their minds. Scott, I think the biggest issue with this, as far as I could tell, was the weather. It was just too soft. The golf course was too soft.
They set it up that way.
And well, it rained. They can't set it up to be soft. It just rained, and they couldn't get the course dry enough, fast enough. Yeah. And the Euros were sticking their irons, and they don't miss putts, man. The Americans
they were throwing darts at every hole.
So on the putting aspect, I was just reading that the Americans didn't practice.
What do you mean they didn't practice?
Yeah,
they played 2 9-hole.
Yep.
They played 2 9-hole rounds.
They played a tournament the weekend before. 9 of the 12 played in a tournament as their warm up.
The European team.
The Europeans played 8 18-hole rounds in 10 days on the course.
So why is that? I mean, this is a question not for us, but shouldn't that be uniform? Like you get so much practice time, you get so much practice time?
I think they got unlimited access to practice time. One team was opportunistic and one team was rather dismissive.
I think what I pulled out from the event was 2 things. One comment I have on the fans, and the other comment is on team golf. The Americans are much better at singles. And the Europeans are not. So if you look at Sunday in the singles matches, it was almost a clean sweep. Only 1 Euro really won, and that was Oberg, who is amazing. And if you look at us in team golf, for whatever reason, like Scotty Scheffler and DeChambeau and these guys in team golf, they just, for whatever reason, do not do well. Scotty was 0-3 in team golf, which is insane.
Yeah.
And then and I don't know if you guys want to jump in on there, but the thing on the fans that, I read a lot on the fans and how egregious they were, and they said some crazy stuff, and I get that. But it's not like McIlroy and Lowry weren't yelling back at him to egg him on. So you can't have it both ways. You can't say, oh, these guys were so rude, they were terrible, and then you go and yell at them. It's either one or the other. Like, they should have just put their head down and gone about their business. And at the end of the day, in the U.S., for sporting events that are team events, I don't care where you go in our country, it's how it is.
That's true.
And I think golf should be held to a higher standard, but if you're going to let in all these people to these events, you're going to get some knuckleheads. It's just inevitable.
Well, you can't have the players talking about how it's their favorite tournament, they're most passionate, they love playing for their country, and then the fans feel the same way, and then because it's not the home match, they get upset. The fans are as passionate about it as they are. Does it cost people to say and do some dumb things? That happens everywhere. Do they need to maybe do a little bit better job of policing some stuff? Yeah, but those are the minority. If the players can be as passionate about it, it's more fun when the fans are just as passionate.
Yeah, throwing stuff at McIlroy's wife, I think we all agree that's
uncalled for.
That guy should be tossed, and maybe calling Shane Lowry
Teletubby.
Yeah, they got on him a little bit about that, but
he stuffed him.
But that stuff's like, it's kind of American sports. I hate to say it, but it is. Like, you go to an Eagles game as a visiting team, good luck.
You got 7-year-olds saying that stuff to you.
Yeah. So, unfortunately, it's just kind of the way it is. And I think golf should be held to a higher standard as well. And I don't like what was said, but I do. The team aspect of it is what brings it out. Like, people were cheering for Tommy Fleetwood 3 weeks ago when he won.
Yes.
Right.
Absolutely.
So it's not like, it is what it is.
So the takeaways, and then we'll wrap up. Europe they outprepared the U.S.
I think that's fair.
They're thin-skinned.
They're better at team golf.
And they're better at team golf.
No
all
doubt
right.
about it.
That's what
I would say Luke Donald, he just seems like a great captain to me. I just think the guy carries himself so well, says all the right things. Seems like his demeanor was A+ all week. And but when you have Tommy and Rory going as well as they were, and John Rahm, I don't think anybody would have beat him. You could have put Tiger Woods and Jack Nicklaus together. I'm not sure they would have beat him.
Right. I think you're absolutely right.
My biggest surprise of the entire week, Tyrrell Hatton not being a complete snap show with the fans. If anybody was
They're afraid of him.
primed, yeah, no kidding. But yeah, shout out to Luke Donald, WGA, Evan Scholar, Green Coat Director, big ambassador for Evan Scholars. Always appreciate that from him.
To Sean's point, though, the Americans are singles. Sunday's golf was an unbelievable display of that singles golf. To go, I came home and thought the thing would have been over by 11 o'clock. To have the U.S. drag it all the way to the end and still be in it down to the last 3 matches, unbelievable.
Well, and here I thought we'd leave it with this nice message about the Evan Scholars. But Scott, you had to chime in. So thank you, everyone, for joining us in the harbor. Until next time.
See ya.